Welcome back, you legends. I'm Dr. Cal, and I want to apologize very quickly for not being able to meet the upload schedule of yesterday. I was hoping to get a video out by Sunday evening. Unfortunately, guys, power went out in my house for a few minutes. When it came back, I think it caused a power surge. My PC simply refused to start for several hours. I had to take it apart, build it all over again. This was at 4 a.m. So I spent from 1 a.m. to 4 a.m. just to try to get this computer to work. 8:30 a.m. it finally turned back on. Thank God. That's just behind the scenes of the kind of crazy stuff that we had to go through to meet these upload schedules. We make nearly nothing out of these videos. I do them because you guys like them and the trading community loves them. So if you guys like them, if you appreciate them, don't forget to slap that like button right in the face. It's totally free, and honestly, guys, it's one of the best ways to show us appreciation on YouTube. Of course, guys, if you're interested in signing up to the Discord community, you can do that on our Patreon page at patreon.com/moneytimemachine. You'll find that link in the description. So let's get right into today's video. This video, I also want to do something completely new. So let's do this thing. Let's add a new layout. Okay, brand new layout. Want to do this from scratch. I want to show you how to identify levels on the chart completely from scratch. No indicators, no nothing. Let's start with the basic one-day chart. I always like to put my chart into logarithmic scaling instead of regular scaling. Regular scaling is fine if you're looking at short-term time frame. So let's say 4 hour and down. If we're looking at the daily chart, I always like the logarithmic scaling, because the regular scaling, the linear scaling, guys, looks at the price action in dollar chunks. So it looks at the rally, for example, from 370 to 380 being equal to a rally from 410 to 420. And that, in my opinion, is completely wrong, because if I do that, look at this, guys. Let's do regular scaling. Let's go from 370 to 380. If you look at it percentage-wise, that's 3%. We go from 410 to 420, percentage-wise, that's 2%. So it's not the same. Logarithmic scaling really irons things out, and it makes all the percentages pretty much equal. So if you, let's say, draw in a vertical line, this vertical line, guys, will span the same percentage. If you put it up or down, it will be the same percentage. So up here, look at this, boom, it's 4%. I put it down here. Let's do that again. Boom, 4%. It's the same. But if I go with linear scaling, again, if I do regular scaling, or what is called linear scaling, let's do that again. Let's draw in another vertical line. Boom. Let's measure this entire move. Here it is. This is what? 7%. If I put it up here, what is this? It's now 6%. Okay, so that's the point. Logarithmic scaling will scale no matter what kind of crazy moves we get. And logarithmic scaling is essential, especially in extremely high growth names, things like Bitcoin, things like semiconductors, because otherwise the chart will simply make no sense. Let me show you what NVIDIA looks like on linear scaling. This is what NVIDIA looks like on linear scaling, right? This entire price action down here looks like nothing, looks like ants moving. But if I actually measure it, that's 30%. Look at that. This tiny box is 30%. This huge box here is also 30%. Does that make sense? It does not make sense. That's why we use logarithmic scaling. Look at that. This now makes more sense. Boom. Down here, this box is 30%, 28%. This exact box is now the same size, and it's roughly the same 28%. I hope that makes sense. Okay. So first things first, we take a look at the SPY. I use the SPY because that's how nearly everybody trades the S&P 500. You could look at the index itself, the SPX, but you can't really trade the SPX outside of options and futures, so derivatives. You can't really directly buy the index. That's why I'll always look at the SPY ETF, because that's what you can actually trade. So that's the first thing. We put the SPY on. We start with a daily chart. We have our scaling at logarithmic. And now we begin to identify levels. Let's start with the basics. Let's use the horizontal line tool. Let's put one at the very top. Duplicate it. Put one at the very bottom. Boom, that's done. We have a range. Now let's identify areas where we had multiple bottoms or multiple tops in the past. This example, very clearly, here it is, a top here, top here, top here, okay? So it's an area of interest. We had multiple tops at this level. Let's put a line, boom, it connects with that top. Now this area confirms to be an area of interest because we had a reaction off of it. And we had a reaction, let's take a look, measure it, boom, 483 days out. So a year and a half out, this area is still important. That means we have to put a line on top of it. Okay, that's done. We have that line. Let's identify more key levels. Let's take a look at this level. Support, support. Here it was broken through. Then we had it as resistance. What does that tell us? Another area of major interest because it acted as support. Once we broke through it, boom, we rejected again at that same level of resistance. We broke down. We came back. We tested that same level. Where's that level? 429. So roughly 430, 431, that exact same gap fill area. Maybe we undershoot it a bit. We had, again, a lot of candles here closing at that same level. So we know for a fact it's an area of interest where there's demand and supply dynamics. Okay, so we have our basic major areas of support and resistance drawn out. Let me change the colors here. So black for our major range and red for this a newly defined range. This is an important range because in the past we traded within that range and we're now trading within that same range again. Let's identify more important levels. Let's say this level breaks. Where do we go next? Same thing, guys. Let's apply the same logic. Areas where it was support before. Here it is, support, then it was resistance, then it was resistance, then it was resistance, then it was resistance, boom, resistance. What's this level? Let's mark it. Boom. Reaction once, twice, 3 times, 4 times, 5 times. It's a key level, roughly 416. What's 416? Well, 416 is the level at which we had this breakout. Boom, we came back down, broke out again, back tested. We had the back test here, and then we had that massive rally. There's another key level. Look at this, rejected, broke through once, twice, back tested here, rallied. So this is a key level, 416.6. Okay, so now we have 3 major levels. Resistance at 457. Okay, we have support at 429, more support at 416. That's the premise that we're going to trade around. Okay, this is the daily chart. Now let's layer on top of the daily chart some indicators. Let's start with the basic stuff. Let's do RSI. A lot of people like to do RSI. Like a lot of people like to use the RSI. I like it as well. Let's do the same thing. Let's look at the RSI. Let's look at key reaction levels on the RSI. Okay, so the green line is a 20-day moving average for the RSI. The black line is the actual day-to-day reading. Let's apply the same stuff, guys. Where do we see the big reactions? Here it is. This is one big clear reaction. Let me change the color. Let's use blue for this one. Here it is. Boom, blue. Why is it important? Let's use the vertical line tool. Let's find it. Here is vertical line tool. Let's put one here. Why is this level important? Well, we had rejection at this level. Drag it again. What happened? We had the rejection at that level. Let's drag it again. Boom. Yes, we had another rejection at that level, a double top, lower high on the RSI. Look at this. A high here. Let's mark it. Lower high just a week later. This high was made on July the 19th, another high on July 26th. We made a lower high here. What was the price action doing on the daily chart? We were actually making a high right here, 455. This high on the daily chart was actually higher. We made a high at 459. What does that mean when price makes a higher high and the momentum indicator that we use, in this case the RSI, makes a lower high? It means that we have what is called a bearish divergence, right? Higher high on the daily chart, lower high on the momentum indicator. It means that buyers are losing control. They're losing conviction. They're buying fewer and fewer shares. They're not as excited at this level, and that's why they're beginning to lose steam. The buying is beginning to lose steam. And that's when we need to pay very close attention, because what happened after that? Bearish engulfing candle. Okay, so we analyze the candlestick structure at this key level. We're seeing bearish engulfing. Bearish engulfing candle is the candle that opens above the closing price of the previous candle, and it closes below the entirety of that candle. So engulfs the entire candle. Look at this. It engulfs it. It eats it. It eats it. Num num num. It ate the whole candle. Okay, that's why we call it engulfing. It engulfs it entirely. Okay, what happens with bearish engulfing candles? They're bearish structures. They're bearish candlestick structures. Following bearish engulfing candles, we look for signs for continuation to the downside. In this case, what happens is that we had 1, 2, 3 days of attempted recovery, high, slightly higher high, lower high, right? Buyers came in, they came in again. Third time, they failed. Momentum, or excuse me, the volume was declining. Price failed to clear the previous high of this bearish engulfing candle. We had volume declining. We have momentum declining. What does that tell us? It tells us that buyers are done. They don't want to buy at this price anymore. They're done buying. In this example, we also had something that looked pretty much identical just recently. So that was luckily easy to read. Here's another one. High, slightly higher high, slightly lower high. 3 candles, and they look like exhaustion candles, right? Boom. Another candle, candle below, right? We did not see follow through. We saw a candle below it. So that was a rolling over look, same rolling over look. We had a gap down, we had a gap down. See, market behaved the same way. It gave us the same clues. It gave us the same indicators. If you look in this example, we also had a bearish divergence. Here it is, higher high here, lower high on the RSI. Exact same thing happened here. Bearish divergence, higher high here on the price action versus here, lower high on the RSI. Exact same stuff. Bearish divergence on the RSI, price action, candlestick structures beginning to look bearish. We're seeing volume declining, and it's all happening at a key zone. That means it's important. When things happen like this, when you see structures forming, either bearish or bullish, at a key zone, it means they matter. They're important, and we'll get a big reversal. In this case, we had a short-term reversal, then we recovered, and we continued back immediately. So it was just a short-term reversal. In this example, it was a medium-term reversal. Can you predict whether it's going to be short-term or medium-term? Sometimes you could see some hints. You can see some hints that maybe some things are happening. And in this example, the hint was the NASDAQ. Why the NASDAQ? What was happening with the NASDAQ? Let's add it so you guys can see. Let's add the NASDAQ. Type in triple Qs. Here, new price scale. Let's add it as a new price scale. I already changed the color on this chart to blue and black. Okay, here it is. This is the NASDAQ. And what do we see with the NASDAQ? In this example, we had the S&P making a higher high, and the NASDAQ made a lower high. Usually, guys, the NASDAQ leads the market in rallies, also leads the market down in sell-offs. That's what was happening. The NASDAQ had already made a high, then it made a lower high, and the S&P 500 had made a higher high. This was a divergence. S&P higher high, NASDAQ lower high. Again, we have the NASDAQ diverging. We had the RSI diverging. We had candlestick structures that were looking bearish. So all of these were signs, and it was happening at a key level. Okay. In this example, we also had a bearish structure. It looked like a double top, right? But we did not have any follow through. The market gapped down, stayed flat, then it bounced. This example, the market gapped down. It had follow through to the downside for a day, another day. Then it moved sideways, right? And then it never recovered this day. This breakdown day, it never recovered it. In this example, the breakdown day was recovered 3 days later. That was a sign that, okay, this is just a short-term thing, and we're bouncing back. In this example, it was not recovered, rejected once here, twice again, and we continued to move back down. We did have one attempted rally here. It was cut short in the post-market session and the pre-market session. Essentially, this was futures manipulated to end this counter trend rally short. It should have rallied all the way back to this area of resistance. It was cut short in the futures, and then we came back down. That's why it's important to analyze both the ETF, the SPY ETF, and the futures. So let's add the S&P 500 futures on here, S&P E-mini futures. What did the futures do? Well, here it is. This was the bounce that was in the S&P, and the futures ended up dumping it. Immediately, let's add the S&P so you guys can see SPY ETF. Here it is. The SPY ETF is in blue and black. This was the counter trend rally, and the next day, the futures sold it. If I take a look at the 2-hour chart, so let's drill in deeper here in the smaller time frames. Here it is, attempted rally, closed, and then the futures began to sell it immediately. Look at that. Immediately, the same day, late at night, they began to sell it. So that was a bad sign that something was happening, that futures were leading the market down. And it's much easier to manipulate the S&P 500, the indices, through the futures because you only need a fraction of capital to create a lot of activity in the futures. In fact, Kramer talked about this exact thing in a very rarely seen interview. I think he wasn't aware that he was being videoed or something, and he actually talked about him manipulating the market as a hedge fund manager, using futures to create activity. He talked specifically about how he did it, and that is fake a rally, okay, buy the market, then sell it late at night in the pre-market session before the real market hours, for the typical 9:30 a.m. to 4 p.m. Stock market trading hours. If you operate outside of those hours, volumes are low, you can move the market with much smaller capital, and that's kind of what he did, and he admitted it on camera.
There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it is a very quick way to make money and very satisfying.
And so that's why we need to look at futures from time to time, especially, and I would say this, especially when we're trading against the trend. If you're trading against the trend, please watch the futures. If you're trading with the trend, you don't necessarily need to pay that much close attention. Okay, so I talked about a lot of levels on the S&P 500, the SPY. Now, let's just talk about candlestick structures. And in this example, on top of our momentum indicator, the RSI, let's add another indicator. Let's just use moving averages, okay? Let's use EMA. So I'll use colored EMA. Here it is. Added it, okay? Double click it, inputs. What do we want? Let's use the 50 and the 100 exponential moving averages. Those are the most basic. I would say the 20-day, the 50, the 100, and the 200 are the most widely traded. The 20-week, which is equivalent to the 100-day, is what is usually referred to as the mean reversion moving average. So let's add another one. Let's add another EMA. Boom, colored EMA. Double click it. 100. Let's change the color on this one. Double click, style, change color to blue. Add more thickness, thick daddy. This thick daddy is the 100-day. This is the mean reversion moving average. Let's change this color and thickness as well. Let's use dark red, okay, to differentiate. Okay, so the green moving average is the 50-day EMA. The blue moving average is the 100-day EMA. And what do we have here? Well, let's take a look at the futures. What do we have? We have 3 days of selling, 3 solid days of selling, breaking below the 50-day. Often what happens when the market breaks the 50-day, it moves back down to the 100. I'll show you several times this has happened. Boom, we broke the 50, we moved down to the 100. Let's actually look at a bull market. Here it is. 50-day broken, we move back down to the 100. 50-day held, we continue. 50-day held, we continue. When we hold the 50-day, we hold it. When we break it, we move down. Here in this example, we broke it, we almost went back down. Okay, very nearly. This example again, broke it, continued down, broke it, continued down. Let me scroll out so you guys can see. It's a very clean looking chart, just 2 moving averages, the 50 and the 100. Again, when we break it, we move back down to the 100, we hold. In uptrends like this entire uptrend, we tend to hold, we tend to hold, we tend to hold, okay? In bear trends, we tend to break through it, reject, come down. It happened once here, boom, boom, boom. And then when we began to make higher lows and higher highs, that established a new cyclical uptrend that I talked about. I dedicated an entire video just talking about this, calling this a cyclical bull rally. This entire move, a cyclical bull rally. And then when we had this additional structure, I talked again, had a dedicated video just about this. This was a very clear, to me at least, volatility contraction pattern. A volatility contraction pattern is the most bullish stock market structure you will ever see. It's the most bullish by far, and it leads to massive rallies. That's exactly what happened. Okay, so what's the point? Well, the point is, guys, we held the 50. We tried to bounce off it the next day. Here it is. We held above it, tried to bounce, failed. This was a crush. This was a sell-off in the futures. This was entirely futures led. Could it have been manipulated? Absolutely yes. Was it manipulation? We cannot be certain, but it could have absolutely been manipulation. We just don't know for sure. We can never know these things for sure. Okay, we broke below the 50. We continued all the way down to the 100-day. We had what is called a hammer candle. A hammer candle, guys, is a bullish bottoming candle when it comes at the end of a downtrend. Here's an example. Bullish hammer. We rallied. Bullish hammer. We're now rallying. Another one here. Bullish hammer. We had some continuation. Let's look for more of these. Here's another one, bullish hammer. After a sell-off, we bottomed. Here's another example. This is a variation. This is an inverted hammer. Inverted hammer is a hammer with a body to the downside, okay? With a body in the lower half of the candle. It's also bullish when it comes at the end of a downtrend. At the top of a trend, it indicates a sell-off. At the bottom of a trend, it indicates a recovery. So it's a reversal candle, what we call an indecision or reversal candle. There are so many examples of these candles, guys. Another hammer candle, boom, rally, hammer candle, boom, rally. This example, we had a hammer candle, failed to follow through the next day. That invalidates the candle, and we had continued weakness. All candlestick structures, without exception, need follow through for confirmation. This example today, we had follow through to the upside, that's confirmation. This example, we had follow through to the upside, that was confirmation. Confirmation means we just continue to rally up and up and up. Not necessarily. Tomorrow we could get another candle that is a sideways candle, another one like this. That's possible. We could get a lot of these sideways candles. That does not invalidate the structure as long as that we don't break below the open of this candle, okay? A huge red-bodied candle, boom, followed by a hammer candle, followed by a huge green-bodied candle is called a morning star candlestick structure. This is a morning star candlestick structure. Big sell-off, indecision, big rally. The psychology behind it is that we had sellers. The sellers are now indecisive. In that indecision, the bulls took back control, and they're now leading the market up. Okay, it's a reversal structure. A morning star candle is a bullish reversal structure. We also have the opposite, which is called a evening star candlestick structure. Here's an example. Big rally, indecision, rejection, inverted hammer candle, and a sell-off to follow through. That's now an evening star structure. That's now an evening star candlestick structure, and it's bearish. And then we had sell-off. Follow that. Okay. So we went through all the basics. We went through how to identify key levels. Just look at levels where the market consistently saw turnarounds, rejections, okay? On the futures, what are those levels? Clearly, guys, one rejection here, another one here, another one here. This is a key level. Okay, you can put it at the top to be safe. That's where we had a rejection. You could put another one here at the bottom. That's where we had the minor rejection. So all of these levels matter. Okay. Next level, where's the next level? Well, we had support here, rejection, and a lot of trades here. So this is a key level. Let's add this level in our chart. It's important. What are the levels to watch? Let's go and zoom in closer. Okay, we had rejection. So this is an important level. Let's add another line. Let's change the color. Let's go with black, and let's use 2 pixels because this is a shorter term key level. buyer stepped in here, buyer stepped in here, another key level. So what does that tell us? Okay, if we break a key level, we usually go to the next one. So if you break this level at, let's see, 4,500, basically, we move higher to 4,536. Okay, if we reject this level, we usually go back to the previous support, which is 4,370. Okay, if this level breaks, we go down to the next support, so on and so forth. So price moves, it breaks here, it continues higher. If it gets rejected, it comes back down here. If it gets through this level, it goes back here. If it goes through this level, it goes back here. If it finds support, it goes back here, so on and so forth. Price action likes to bounce between these levels. Now you're almost ready to basically trade charts on your own. Let's add one more indicator. One of my favorites is the PPO. Here it is, the PPO by JFX. I like to use this one. Let's add it. It's pretty much like the MACD, guys. They're very similar, but the MACD looks at the absolute difference between the moving averages. The PPO looks at the percentage difference between the moving averages. So it's kind of like that example that I showed you in the video earlier between going with logarithmic scaling, so percentage difference, regular scaling, absolute difference in terms of dollars, and then here, logarithmic difference in terms of percentages. Okay, so how do we use the PPO? How is it different from the RSI? On the RSI, we look for divergences. A lot of people will say RSI, MACD, PPO, etc. These are lagging indicators. And that's true most of the time. But if you know what to look at in them, they're actually leading indicators. And an example of a leading indicator in this case is this. Look at the RSI. Here it is. Let's use a trend line here. High, a higher high. This is a lower high on the price action. It's actually a higher high. Let's change the color. Let's use 4 pixels. Let's use dark red. Okay. So there you have it. There's a divergence right here. Okay, this is a leading indicator. A divergence is telling you that momentum is slowing. Price direction will change the more you see divergences and the stronger the divergences are. PPO, same exact thing. Lower high versus the high back here. Then we had another divergence. Look at this. Slightly higher high here. Boom. And on the RSI, lower high on the PPO. Let's expand it. There we have it. Another lower high. Okay. Another lower high. Higher high here, lower high here. Let's do that again. PPO has now crossed down. The blue line is now below the orange line. What does that mean? Well, it means whenever you get a cross down, whenever you get the blue below the orange, it means that momentum now favors the bears. What does that mean? Well, it means that rallies will not run as far and they will be used to sell into. That means we're now beginning to turn away from making higher highs into making lower highs. Also means that we're turning away from making, boom, look at this, higher lows into making lower lows. So this low is lower than this low is lower than this. Hope that makes sense. When it's turning down, when the PPO is turning down, when the histogram is red, you will see lower lows and lower highs. When the opposite is true, you will see higher lows and higher highs. Generally speaking, not always, but generally speaking. One of the main differences between the RSI and the PPO is that the PPO will show you these crossovers and it will begin to signal changes in trend. You will not see that on the RSI. There are no crossovers. There are no crossovers in that sense. You will see the daily reading potentially cross above and below the 20-day moving average, but that's not always useful. It is not always useful because you'll get a lot of these false signals. For example, here, cross down, cross down, cross down. But on the PPO, it stayed up. Okay, so for crosses, I would use the PPO. For divergences, I would use both. I hope that makes sense. Crosses usually, guys, signal a change in trend. Look at this. Cross down, market sells off. Cross up, market rallies. Cross down, market sells off. Cross up, market rallies. Cross down, sell off. Cross up, market rallies. It's one of those very basic trading strategies to use those PPO and MACD crossovers. They're usually lagging. Look at this. They usually lag. The crossover came after the market had already bottomed by more than a week. Example again here. It came in late. And that's why we use divergences, because they're leading indicators. We had a lower low here and a higher low on the PPO. This is a perfect double bottom. Boom, lower low on the price action, higher low on the PPO, double bottom bullish divergence. Perfect entry, perfect entry. If you guys like this kind of analysis where I start from scratch and show you how to use every single indicator, how to read it, how to combine key levels with candlestick structure analysis, and how to read that and how to react to that, please tell me in the comments and I'll do more of that if it helps you guys. Now, let's go back to our charts. Let's talk about the NASDAQ. What are the key levels on the NASDAQ that I'm watching? Again, 3 key levels. 352.5 is support. 365 is the first level of resistance. We actually rejected exactly at that level today. 370, second level of resistance. I used the same principles, guys. Look for areas of key reactions. Resistance, resistance, boom, resistance. Okay, key level. Same thing here, guys. Support, support. And once we broke through it, it is now acting as resistance. This is a minor resistance. I hope that makes sense. So that's what we're looking at on the triple Qs. The NASDAQ did break below this support line, but we recovered it immediately. So that for now, invalidates that break just for now. If we come back below it, it will validate the break. Okay, a single day break is not valid. We need follow through. So that's a key thing that we have to mention. It's so similar to candlestick structures. You need follow through. Same thing with the candlestick structure and these trend lines, you need follow through. Most of the time, you'll get a perfect tag and a bounce off the trend line. Sometimes you'll get a fake out like Friday. And in fact, I can't really say it's a fake out. We don't know yet because we could see a reversal this week after we tag all of those resistances and come back down and break the trend line again. That's very, very possible. Okay, so if we break this trend line, what other trends should we look at? Let me look at the NDX, so the NASDAQ 100 index, the actual index, not the ETF. Let's use the same trend line. Here it is. Boom. Here we have a perfect tag. Look at this. Perfect tag, perfect tag. Here we actually threatened that support, but we broke back above. So far, it appears to be that this support is holding for now. What happens if this support breaks? Well, we tend to move to the next level of support. Where's the next level of major support on the NASDAQ? The NDX. Well, let's use the same horizontal line tool. Okay, a lot of reactions here. Resistance, resistance, resistance. So this is obviously a key level. Let's add a level here. What else? Where do we also have another key level? Let's see, support, resistance. This seems like a key level. Let's see, resistance, support, and then a bunch of reactions here. Not that clear of a level, but it's useful. What else do we have? We also have this gap. Okay, let's move it down slightly. Let's connect it to this high. Now let's see, does it improve it? Does it improve this level? It kind of does. Okay, resistance, resistance, support, perfect support, broke through it. Resistance, let's see, and again resistance. Okay, so this level is important. Let's add another one. So this is a range. It's more of a range. This is more of a range, and this is a key level on the NDX, the NASDAQ 100. If this support line breaks, we will likely go back to test this level. Previous resistance, now support, a gap to fill. A lot of things happening. So I actually like this level. Let's use Fibonacci's to see if this level makes sense on Fibonacci retracements as well. And look at that top here. Fibonacci, a perfect tag of the 23% Fibonacci level. And this level is at the 38% Fibonacci level. So it makes sense. It makes sense. This entire range from 50 to 38 makes sense. A lot of reactions here, a lot of reactions here. These levels make sense. Okay, let's take a look at the Dow Jones. They had a target of a gap fill of 342.8. We filled that gap perfectly Friday. We had another bullish hammer candle today. The Dow Jones is not leading as much today because we had that short squeeze rally in the NASDAQ. And one of those key charts that I watch to see the relative performance of the S&P, the NASDAQ, and the Dow Jones is the triple Qs divided by the SPY. Sometimes I use the triple Qs divided by the DIA, the Dow Jones as well. But I think the triple Qs divided by the SPY is the better tool. Very easily, guys, we could be looking at a back test of the 50-day. Look at it. Look at the 50-day. It's now flat. We could easily be looking at the back test of the 50-day rejection, and we continue down to fill this gap easily. Another trick that I talk about to find levels is these beautiful channels. When channel support is broken, we usually double the distance, and that way you will find the next level of support. So this was support, support. It broke here. We double the distance, so we put the middle of the channel at these levels. We get the next level of support, and it's actually at the gap fill by early September. So it makes sense. XLY divided by XLP, we're now forming another bull pennant. Still really ping-ponging between these levels. The PPO is crossing below the zero line, so it is weak. This is consumer discretionary relative to consumer staples. So we're looking at stocks like Tesla and Amazon relative to more defensive names like Coca-Cola, Pepsi, Costco, etc. Okay? Why is it important? Well, because when the market is rallying, you will see discretionary stocks outperforming staples. You will see risk taking in the market. You will see market participants buying higher risk assets like Tesla and Amazon, dumping lower risk assets like Costco and Pepsi, and vice versa. In turbulent market conditions, you will see staples outperforming discretionaries, and you will see stocks like Costco, Pepsi, Coca-Cola, Procter & Gamble, etc., outperforming stocks like Tesla and Amazon. And so far, since that high on July the 19th, this was actually the NASDAQ high. I remember that off by heart, in fact. Let me add the NASDAQ. Boom, look at that, July 19th. That was the high in the NASDAQ. Since then, we had underperformance of the NASDAQ to the S&P and underperformance of discretionary relative to the staples. What would you like to see if you're bullish? Well, you would like to see this resistance broken, and you would like to see the PPO form a bullish crossover. If that happens, I think that will lean more bullish. That will lean more toward this correction being over. But another indicator that I like to watch, and it's the copper to gold ratio. The copper to gold ratio actually formed this massive, huge bearish divergence, right? Lower high versus the highs in February as the S&P made a higher high. Usually, guys, these bearish divergences end up with breakdowns. We did have that breakdown and sell-off. Is it over? We don't know yet. It could be potentially over in the short or medium term, but we don't know yet. We will likely see more selling going into October. Okay, what is the copper to gold ratio doing? Well, it's rallying, okay? In fact, we had a rally in the copper to gold ratio back on August the 17th when the market was selling off. The copper to gold ratio was rallying, okay? So it was a leading indicator that the market was about to reverse to the upside. Okay, I hope that was helpful. Now let's talk about the value line index. Again, equal high on the value line, higher high on the SPY, the S&P 500. This is a bearish divergence, ended up with a sell-off. What is happening with the value line index? We have formed a bull hammer as the close of Friday. Let's try and update this chart. Refresh, let's see. Okay, this chart has unfortunately yet to update, so we'll have to look at this chart again tomorrow, but we did have a bullish hammer on Friday. Let's take a look at the CPC and the PC, the money time machine. Put to call ratio, buy and sell signal. We had a sell signal on both of these, the CPC and the PC. On July the 26th, the S&P ended up topping exactly a day later. Okay, so what happens next? What are we looking for? Well, what happens, guys, is usually the market will find a bottom after the CPC has crossed above the 1.1 level, okay, after it goes above it, and comes back down, and the PPO produces a bearish cross. When that happens, when the PPO produces a bearish cross and the CPC crosses above 1.1 and comes back down, that's when the market finds a bottom. Example is here. Another example is here. These are critical signals, key signals. And the closer we get to 1.1 and above, the more likely we are to form bottom. Okay. In this example, guys, we did not have a bearish cross until, let's see, October 5th. So we did move above 1.1 and come back down, but we did not get a bullish cross, which is, a bearish cross, which is a confirmation that puts are now being sold and calls are being bought. That's basically what this cross means. We did not get one until October the 5th. The market ended up bottoming just 3 days or 4 days later. This example, the market had already bottomed. That's what I'm looking for now. I'm looking for the CPC and the PC to cross above this critical threshold, come back down, and after coming back down, I will look for the PPO to produce a bearish signal. Bearish signal in this context would mean, or a bearish crossover in this context would mean that puts now becoming cheaper relative to calls. That means put holders are now selling their puts, they're turning bullish, they're buying calls. I hope that makes sense. This is my own variation of this indicator. You will not find this indicator anywhere else. You will find the PC and the CPC, but without any of these key levels, without any of this analysis on the crosses, you will not see any of this. This is just, all of this is my own variation of the indicator. That's why I trademark as Money Time Machine, CPC and PC. And this indicator and the PC is, both of them are available to all members of the Money Time Machine trading community. Okay, what's happening with the summation index? The summation index is very similar to the PPO in terms of finding market turns. It's very easy to read. This is the New York Stock Exchange summation index. This is it down here. When it crosses down, red light, we go down. When it crosses up, green light, we rally. Cross down, red light, we sell off. Green light, we rally. Green light, we rally. And then let me add a red light here. After the cross, there it is. Red light, we sell off. Now we're waiting for a bullish cross. Another bullish sign that we would normally look for is a bullish divergence below the summation index on the McClellan oscillator. What are we looking for? We're looking for something that looks like this, an extreme low. Here it is, extreme low, higher low, with the New York Stock Exchange making a lower low, and with the S&P 500, here it is, making a lower low. That's a bullish divergence. Price making lower low, oscillator making a higher low. That's a bullish divergence. That's what we're looking for. Sometimes we don't get that. In this example, we just got two dips, 1, 2, double bottom. That called the bottom perfectly on both the NYSE and the SPY, the S&P 500. You can go back several times, guys, and you'll see the same thing. Here it is, double bottom, lower low on the price action, higher low on the oscillator. So I'll update you guys whenever we see either a bullish divergence on the oscillator or we're getting closer to a bullish cross. Both of these are bullish signals, bullish reversal signals, and often, guys, the summation index will set the trend. Okay. Here is the NASDAQ summation index, exact same thing, guys. We either get a double dip and one final bullish divergence. Here it is, lower low on the price action, higher low on the oscillator. It called the bottom. We got a bullish cross to confirm. We got a bullish cross to confirm just a few days later. Okay, we're now looking for that same thing. Not there yet. That's why, guys, I am in favor of a back test of the 50, a move back down, a lower low on the price action, higher low on the oscillator, and a cross coming in after that. Okay, that's why I'm in favor of a back test and a sell-off, because that's what usually happens. Rally, another dip, a double bottom, and a double dip on the oscillator, and that was it. That was the bottom. In this case, we had a bullish divergence. Okay, here it is, lower low versus this low, boom, boom, and a higher low on the oscillator. It called the bottom. Another example is here, higher low on the PPO, the oscillator, lower low on the price action, first low, second low, first low, second low. Okay, let's talk about the VIX. Another key indicator that I watch is the VIX. The VIX actually formed a bearish engulfing candle today. That usually means that we'll see follow through to the downside in volatility and upside in the market, because when volatility moves up, the market moves down, and vice versa. Ultimately, I'm looking at the VIX to hit 25 by October. I think that will form the low for the year, and we'll see a rally from that point on. In the short term, we're seeing volatility come back down. It had, again, a beautiful green candle, rejection, tombstone candle, followed by a bearish engulfing candle. What is this? It's an evening star structure. Again, big green candle and reversal candle down here. Bearish engulfing to follow through. It's a morning star, it's an evening star bearish structure. And what is bearish for volatility? It means volatility comes down. It means the S&P 500 rallies. So it's a contrarian indicator, guys. Whenever we say there's a bearish structure in volatility, it means that volatility is ready to move down. Okay, that whenever volatility moves down, the market likes to rally. Talk about fear and greed today. Fear at 46, okay, or it should be, I should say, neutral 46. So we could see a bounce back to greed and then a sell off back to fear, and that will likely establish the bottom. Market momentum, a price strength, both still at greed. Stock price breadth is neutral. Put to call ratio, the CPC and the PC. This is kind of a variation of what I use, but what I use, guys, marks, tops, and bottoms. Much more accurately, I put it down to a science. Basically, market volatility shows fear, safe and demand shows fear. So it's still a bit of a mixed bag here, guys. Not enough yet to call a big bottom. Not enough yet, but there are some bullish signs in the short term. In terms of economic events today, nothing important happening until Jackson Hole Symposium on Wednesday. So keep an eye out, guys. Jackson Hole will last for 3 days. Wednesday, boom, Thursday and Friday. And we have NVIDIA earnings post-market August 23rd after the market close on Wednesday. That's all I have for you today, guys. I hope you found it helpful. If you did, please show us some love by slapping that like button in the face. If you've watched till the end and you did not find this video helpful, I do thank you for your time and attention. Check out our Patreon page to support the channel and to join the Discord trading community where I share all of my personal trades and investments and all of my trade setups and my daily market analysis. Thank you, legends. Have a good one. Bye-bye.
Oh, wow.